Hey, good afternoon. Jeremy Andrews here with Master Plan Tax Solutions. Just wanted to come to you today and talk about S-Corps. So before we get into that, I just want to talk about sole proprietorships and partnerships. So sole proprietorship and partnerships, sole proprietor being a single individual performing services for his or her business, partnership being more than one individual providing services to the business and to their customers. To the IRS, those are whether it's a non-incorporated business or an incorporated business like an LLC or Inc. or LLP, so forth and so on. The IRS sees the net profit generated after taxes as self-employment income, meaning it's not only taxed from a federal income tax perspective, which the only way to reduce that is to have qualified business expenses. But it's also taxed from the self-employment tax perspective. That's Social Security and Medicare tax. And that tax alone is 15.3% up to around $170,000 right now. But that, again, that's in addition to your federal income taxes, which could be 10, 12, 22, 24, on up to 35%. So the two together could easily be 50% tax pretty quickly. Um, and so the idea with, so let me first talk about LLCs, Incs, LLPs, things like that. That doesn't automatically make you a corporate business in the eyes of the IRS. It's just a state legal entity recognition. It's asking the state to see the business separate from the individuals, the owners. In the event that someone brings litigation against the business, the idea is that it provides protection from that litigant coming after your personal assets. Um, but again, that's just a state legal entity recognition. Um, by taking that state legal entity, LLC, for example, and converting that to be recognized as an S corp with the IRS, you're asking then the IRS to see the business separate from you, the owner. And so what happens is you then become, if you're materially participating in the business, providing personal services to the business, you become an employee of that new tax entity. And those owners who provide personal services in the S corp must have reasonable W-2 pay set up for themselves based on their title, their tasks, the number of hours they put into the business, things like that. But any net profit that's generated over and above that reasonable pay can be shielded from the self-employment tax, because the idea is now that the business and its employees and its assets are creating the revenue, the net profit, not you, the owner, solely. So to give you an example, let's say today a sole proprietorship, even if it's an LLC, single member LLC, not yet an S corp, but let's say that sole proprietorship is generating $100,000 net profit after expenses. Well, on that $100,000, again, you're not only going to pay federal income taxes, which could be 10, 12, 22 on up, but you're also going to pay that 15.3% self-employment tax. Um, and so that self-employment tax alone there on $100,000 could be $14,000, $15,000. Um, if that same business was seen as an S corp tax entity with the IRS, and it's generated 100,000, and let's say that owner's services they provide, the reasonable pay for that owner employee is $60,000. So on that $60,000, they're going to pay Social Security, Medicare, no change there. But the difference, the $40,000, the $100,000 net profit minus the $60,000 reasonable pay, that $40,000 is shielded from the self-employment tax. So they do not pay the 15.3% self-employment tax on that 40,000. So in that example, they're saving about $6,000 in self-employment taxes. And then it goes up as the net profit continues to increase. So you can see the savings there. So those are some things that we do. Please give us a call. Let us know if you have any questions about it, thoughts about converting your business. We're glad to answer those. 682-444-7526 or info@masterplantaxes.com. Thank you so much. Have a good day.